February CPI coming in at 4.4% versus our expectation of 4.6%. Even if you look at the way it was for the month of January, it was at 5.07% and now at 4.4%. Let's take it across to our guests, Gaurav Kapoor, Indraneel Pan, Maithili Bhusnurmat and Mr. Shivakumar, who are now joining in. Gaurav, let me come to you first. How are you reading the headline number for the month of February? The February CPI coming in at 4.4%. The expectation was that it may come in slightly higher, but a significant easing that we are seeing that's happening for the CPI.
Yeah, I think it's about 30 basis points lower than what we had expected, and precisely, I think close to what even the consensus expectations were, around 470. So I think the month of Feb, you had a very sharp correction in vegetable prices. So I would think that would have contributed to the number coming in lower than expected. And this was also a month where oil prices came down. So you saw the Indian basket coming down from 67 to 63 in the month of Feb. But crucially, and this is of course the number which the MPC will have before the next meeting. But importantly, I think we need to see how the core part of the inflation is looking like. My sense is that may have not changed significantly from the January level of 5.2, but we'll have to see. I mean, I'll have to see the internals to really get there. But the headline clearly lower than expected. Actually, even from the MPC's RBI's own estimate of 5.1% on average, including the HRA impact, this number clearly at about close to 70 basis points lower from there. It's definitely a positive surprise.
In fact, I have some of the numbers. I'm still awaiting the core sector data, but food inflation coming in at 3.26% versus 4.7% that we saw last month. So that is also a significant easing that's coming in. And this data clearly, should give some sort of a breathing room to the RBI as well. Maithili, how are you reading this number?
Well, it's very much in line with expectations because winter months typically see prices coming down, particularly of fruits and vegetables. So this was expected, but unfortunately February is perhaps almost the last of the winter months, and as summer approaches we will see the prices of fruit and vegetables going up, and particularly we've seen the kind of farmer distress and the way governments are willy-nilly kowtowing to their demands, then I'm afraid going forward the outlook for food inflation does not look too bright. So we will see inflation inching up, but clearly for now this is good news. The RBI unfortunately will not have too much to kind of take comfort from, because increasingly I think inflationary forces are being driven by global factors, and there the message is very clearly on the wall. I do not think the RBI has much room for leeway. It will have to either hike rates or it will be status quo.
Right, let me also take it across to Indraneel Pan. Indraneel, what's your own assessment? Do you also believe that going forward, this inflation number, this is just a temporary relief, and while it has come in at a 4-month low and much, in line with the RBI's own comfort zone, this number is going to significantly increase going forward, given the fact that we are seeing significant easing coming in for food inflation as well as rural inflation as well?
Our sense is that yes, inflation might actually go up, but I do see it as relatively a lesser risk than we were looking at it, say about 2 to 3 months back. I'll highlight the reasons. One, oil and most of the commodity space in terms of the metals have actually sort of steadied out. In fact, they are slightly softer. One risk of course continues in terms of how the domestic currency moves. I'm referring to the USD INR. However, having said that, I think for the RBI, even though this might be a relatively comforting number, I do not think that there is much sense that I am getting that inflation would actually come back closer to the 4% or the sub 4% level. So my broad range for inflation remains at around say 4 to 4.5 for the next 10 to 12 months. With 4 to 5.5 for the next 10 to 12 months, with 5.5 being seen somewhere around June, July 2018. One of the critical reasons being that of a base effect. In terms of the food prices, I think yes, there are the trends are likely to be emerging as we go ahead, and one of the major sort of factors that we need to look forward to is the monsoon and the overall spread of the monsoon in that context. Not only that, but we'll also have to need to look at the MSP increases that are announced by the government in terms of the kharif crops. So I think it's a massive constellation for the inflation at this point in time.
But just give me a moment. The IIP numbers have also come in, and looks like it's a double delight for the economy. The IIP growth momentum has, in fact, picked up. The expectation was 6.5%, but the number that has come in is 7.5%. And this, if you look at the December number, that was close to 7.07%. So we have seen some bit of an uptick coming in there also. Maithili, how are you reading the 7.5 number, and also, the fact that we are seeing significant easing of inflation as well? Do you believe that perhaps now, given the way the economy is out of the woods, we can safely say that things are going to look up from here on?
Well, in macroeconomics, you can never really say anything very safely. But since it's the third month where we've had 7+% growth, I think one can definitely say that we are edging out of the woods, because if you remember, there were fears that even though recovery is here, the pace of recovery might come down. So to the extent that we have 7.5 as against 7.1 the previous month, it does seem to suggest that those fears were unwarranted, a little exaggerated, and the recovery is here to stay unless we do something to really scupper it. And that, I think, is something that we are notorious for. So I think we really need to hold our horses and just hope that we allow the recovery to take root, because going by the way we are seeing banks holding back on credit for a variety of reasons, some of which are entirely within the policy domain and could be corrected. I would hesitate to say we are entirely out of the woods, but yes, it is within our hands to see that the recovery is sustained.
Absolutely. Let me also take you through some of the internals. The manufacturing output for the month of January has come in at 8.7% versus 8.5% in December. So we are seeing some bit of an uptick there. A significant increase for electricity production, which has for the month of January come in at 7.6% versus 4.4%, and mining output that has seen a dip. As compared to 1.2% in the month of December, this time it has come in at 0.1%. What's your own assessment, Indranil, of the IIP numbers that have come in? And can one safely say that the economy is out of the woods, given the fact that Maithili was also pointing out that how this number is more than 7% consecutively for the last 3 months?
I think yes, the number is definitely better than what we had expected, no doubt. But I think, as Maithili rightly pointed out, it is the sustenance of the recovery process that is likely to be more important from the Indian context. And also the other important thing is the huge changes that are possibly happening in terms of the global trade front, and we really need to watch out what could be the broader ramifications of the US increase in the aluminum and the steel tariffs on the rest of the world in terms of reciprocal reaction to the same, and to what extent therefore the global growth gets hampered. So I think it's too early to really sort of paint an extremely rosy picture in terms of the growth trajectory going up only. I think it should be we are out of the woods, no doubt. We have seen the bottom is past us, no doubt, but the incremental pace of recovery is something that we really need to be cognizant of.
In fact, let me also ask Mr. Shivakumar, sir, what's your own sense? Are we going to see sustained recovery from here on? Because that's what all the other panelists believe, that that is going to be one factor that they will be watching out for, especially at a time like this when we are seeing protectionist measures being taken across the globe. And how would that really pan out for our own industry?
First of all, we need to keep in mind a couple of factors. One is we are comparing these last few growth prints to the same period just after demonetization, and therefore to some extent it could be overstated, and we need to wait for this for the next few months to confirm that genuinely this is a year-on-year growth rather than just a statistical effect. Having said that, two big impacts on the economy, demonetization and GST, did drag down the IIP growth rate last year. So, if now having left that behind, it will be genuinely, good if the growth remains at 7 or in fact even accelerates from here, and we could be in a sort of a Goldilocks situation if inflation remains well contained, let's say below 5%, and if growth can actually accelerate well past 7. So I think this set of data that we've got today is absolutely perfect.
In fact, talk to us about the manufacturing sector, because when we did get some of the lead indicators ahead of the number this time around, they were showing a mixed trend, so to say, because look at the manufacturing PMI, that was showing a mixed trend. For the month of October, it was around 50.3. Then in November, we saw slight bit of an uptake. Even in December, it rose, then fell sharply in the month of January. And while we are seeing some sort of an uptick this time around for our manufacturing number as well, do you believe that it is going to be sustainable as a trend?
I do believe that there is a trend of underlying growth. Like I said, statistically comparing ourselves to the period of, let's say, December 16, January 17, the low base effect that was created because of demonetization makes the current growth numbers look a lot stronger. But we need to therefore see this over a period of next 5 to 6 months to ensure that this growth is genuinely there and it's not a statistical blip. Having said that, it does appear that the economy is repairing itself. If you see the longer term trajectory of IIP over the last few years, you do see that the economy troughed out somewhere in 2014 or 15 and then began to accelerate until we had demonetization and GST, when the growth took a dip and then now seems to have picked right back up again. So it does seem that underlying there is a pickup in activity, even though the survey measures like PMI don't seem to reflect that. But I do believe that there is a genuine pickup in growth, and exports, for example, have not been the key driver. This is, I think, substantially domestic. So we are probably a little insulated from any pain on the global trade side. And as long as that's the case, then we ought to be cheering this. If we can grow at 7% plus without a very large contribution from exports, then fantastic, so be it.
Maithili, while we did see some bit of an uptick for manufacturing, the data on the mining front, capital goods as well as infrastructure, that is where we have seen barely any growth happening, because January mining output has come in at 0.1% versus 1.2% for the month of December. The capital goods production coming in at 14.6% as compared to a 16.4% for the month of December. And infrastructure output is also pretty much stable, coming in at 6.8% versus 6.7% for the month of December. Is this trend little worrisome? Because we are seeing, while manufacturing contributes to almost 70% to this IIP number, the trend that's coming in from manufacturing, capital goods and infrastructure also points out to a deeper problem, isn't it?
No, I wouldn't quite put it as a deeper problem, Ruchi. In fact, I think because volatility in the capital goods segment has been always very marked, and so to that extent, I think 14% growth, if I heard you right, in the month of January is not bad going at all. As far as the core sector growth is concerned, it's been positive. It's been going upwards. It's in 6.7% as again 4.5 roughly the previous month in December. So I would think broadly the recovery is on track, but going forward, actually it's true that the base effect would contribute. In fact, February and March of 2017 was when the base effect was marked, and we saw a very sharp dip in manufacturing and in IIP. So the next 2 months in fact might look very good in comparison, but broadly it would suggest that there is a recovery on track. There are just two facets that worry me really. One, what is going to happen on the trade front, because whatever little support we were hoping to get from increased global demand now might not happen. And secondly, as I said, is bank credit. That is something that I find very worrisome, because banks are increasingly not lending, and the fears on the lending front are increasing day by day. So I think these two factors could put a spoke in the wheels, and I think we really need to do everything possible to ensure that that does not happen, just when recovery is picking up steam, because exactly the same thing had happened with demonetization. Just when the economy seemed to be recovering, we shot ourselves in the foot with demonetization, and I do hope we do not repeat that mistake once again.
Absolutely. Indranil, do you also believe so? Because if you look at the January infrastructure output that has come in, that is almost flat, 6.8% versus 6.7% that we saw in the month of December. Do you also believe that part of the problem really lies in the fact that we are seeing very little offtake as far as bank credit is concerned?
Well, I think to a certain extent that may be an issue going forward. But as of now, I think there has been a relatively better bank credit growth than it was in the last year. Obviously, the last year was a period of demonetization, GST, etc. But having said that, I think as I pointed out, the crucial sort of factor that should be noted going forward is the demand side aspect. Given that the government expenditure is unlikely to see any significant upticks in this particular year, our capital expenditure is still at around say 1.6% of GDP, which is almost unchanged at the revised estimate of the last year. So to that extent, I think any uptick or any delta in terms of the growth has to really come from the private investment side or the domestic consumption front or the external demand. Now, in terms of the domestic demand for investments, I think that's what you were pointing out, that the capital goods performance has not been up to the mark, and which might actually continue given the fact that capacity utilization continues to remain at around 72% overall. But the external demand, I pointed out, may actually weaken given that the trade issue is likely to become or could become actually slightly bigger than what we are anticipating at this point in time. So that leaves us mostly with the domestic demand, where the sort of gradual rise in the MCLRs of the banking sector could have a bit of a negative impact. So again, I think from the previous year to the from the current year to the next financial year, the delta in terms of the growth is unlikely to be, or the sort of the overall you need to oil the economy may not be as smooth as we were expecting going forward.
Gaurav, do you also believe that at a time like this, when we are seeing the demand weakening across the globe, especially with respect to the trade tariffs that will come in, the protectionist measures, and given the fact that in the Indian economy we are seeing that the private investment is not picking up, two questions really. A, when do you see private investment revival really happening? And B, I mean, what is it that the government should do at this point of time, and what options do they really have? Because we have seen the government going ahead with fiscal slippage this year, but in the long term, what is it that they can really do?
Well, on the exports front, I think we are making a little, perhaps at this stage we are making a little too much of this whole exports thing. In my opinion, I think when you look at our monthly exports, I think we've pretty much reached our natural kind of ceiling, which in my opinion on an average monthly basis is about $25 odd billion. Yes, in recent months there's been a pickup in steel exports, so to that extent there will be some impact felt there, but I think in terms of what and actually when it comes to private investment activity, I think there are some signs of at least brownfield investment activity picking up. In fact, if you go look at the capital goods numbers which you were referring to earlier, and you look at the numbers from August 2017 onwards, they have been consistently in the positive zone versus being consistently in the negative zone. So I would not read too much into the numbers slipping from 16 odd percent to about 14 odd percent. To me, that is largely base effect, but it's a good sign. I also do not entirely share this concern about bank credit, because I think while there is, of course, there will be pressure on bank credit, as Indranil also pointed out, credit growth at this point in time is actually quite is definitely better than what we've seen in some time. And remember, there are access to non-banking sources of financing also in the last couple of years have become perhaps as important as the banking system. So of course there will be some impact, but may not be, and may not be as bad as we making it out to be. So, and in terms of what the government can do, I think the government, as it has been one of the major drivers of growth in the last 6 to 7 quarters, and I think that will continue in starting in the next financial year. With the advancement of the budget by a month, the government starts the year, the spending actually starts from almost from the day one. So you would see the first 2 quarters and in fact the fourth quarter as well now of this financial year, GVA growth exceeding 7%. My sense is that GVA growth in the next 3 quarters, helped by base effect and the recovery we now seeing in the manufacturing sector, should range somewhere between 7 to 7.5%. Beyond that, I think one would have to hope that the global environment remains supportive, because if, for instance, the global monetary policy normalization gathers pace and that has an impact on domestic interest rates and the currency, then that could slow growth down. But in some sense, I think some correction or some weakness of the currency also would help, because the drag which net exports are creating on overall growth is something which has been kind of picking up quarter on quarter. In fact, in the third quarter GDP numbers, net exports dragged growth down by almost 1.5%. So which means that on the export side, we've kind of seen very tepid growth or flat growth basically exports reaching a flat level. On the import side, we are actually seeing a very broad-based growth. So I think that's something. So some natural correction and some flexibility on the currency is also required to correct for that, I think.
I just have the last 2 minutes on the show. Indranil, what do you think is going to be the RBI's course of action from here on, given the global concerns that we are seeing and the way Indian economy is also panning out? What is it, do you think that the RBI would do going forward?
Well, I am expecting a relatively long period of pause from the Reserve Bank of India. Number one, they would need to look for all the uncertainties that they have sort of highlighted for inflation in their last monetary policy to attain some clarity. The second issue, of course, is the global factor, which nobody knows how it pans out, given that liquidity from the global central banks is gradually getting withdrawn and there are rhetorics of rate increases. So the next big event in that context would be the Fed meeting, where the market possibly is looking at some changes in the dot plot, or we will have to watch out for that. So I think all these perspectives need to be taken into consideration, along with the fact that we are relatively in a zone where we really don't know how or in what direction the global monetary policy pans out, and to that extent what implication it also has on the emerging market currencies. So it's a huge amount of data that the RBI needs to filter through before any action can be taken. And from that matter, if we are saying that inflation, the relative risk of inflation crossing the 6% band is a low probability event at this point in time, and on the other side pull down below the 4% also sort of looks relatively unlikely, I think the pause is the best option for the Reserve Bank.
Mr. Shivakumar, do you also believe that pause is going to be the best option for the RBI going forward?
Oh, absolutely. I think RBI is likely to be on an extended pause as long as inflation remains at very close to their year-end trajectory of 4.5%. So I think they're going to be on pause. I completely agree that especially in the heightened global uncertainty era, the RBI should not be looking to further introduce a new risk by hiking rates in this environment. So it's probably going to be a big pause.
All right, it's going to be a big pause given the fact the way global economy is panning out and the domestic cues as well, and the macro data, the twin treat that's coming in for the economy, CPI cooling off significantly, and factory output for the month of January coming in at 7.5%. With that, it's a wrap on this edition. Let me thank my guests Gaurav Kapoor, Indranil Pan, Maithili Busnurmat and R. Shivakumar. Many thanks for taking your time out and making sense of that macro data. Thanks for watching.
बोलूं?
Maithili ma'am, just stay on with us. I'll take 2 questions for 6 also.